So my name is Brian Ye. I manage the corporate venture capital arm for Digital Garage, the Japanese internet conglomerate. And today we're going to be talking about the topic that has been on everybody's minds for the last year and a half or so. Today we're lucky to be joined on this panel to talk about Spacs, and maybe if you guys could introduce yourselves real quick.
Sure. Shagufa Hussain. I'm a partner at Latham & Watkins. I do a lot of Spac transactions, represent Spacs, targets, and everything in between, pipe investors, the whole gamut.
Sure. Chris Weeks, Managing Director and co-head of the Spac business at Cowen, which is a middle market investment bank based in New York.
Jeff Ransdell, I'm the CEO of Maquia Acquisition Corporation, which is a Spac headquartered out of Miami in Mexico. And I'm also the Managing Director and founder of Fuel Venture Capital, which is founded here in Miami.
Great, thank you guys for joining. So obviously this is something that we've all had on the tops of our minds over the last year and a half since Spacs have really kind of come to the forefront. And I thought for today's conversation, we'd break it down into the following themes to talk about market dynamics, some of the regulatory changes, and what would constitute successes and failures in a SPAC transaction, as well as what we thought would be, what we think how the market will evolve in the future. So maybe just to start it off right away, Chris, I want to throw it over to you since you're in the investment banking side in the middle of everything. Like, can you maybe share a little bit with us on what you've seen in the market so far year to date, and what if you could share some stats that would be helpful to give us some color?
Sure. Well, I mean, it's hard to ignore what's going on in the SPAC market. 2021 has been a record year, actually coming off a record year in 2020, frankly. There has been, it's also been a record year just generally across the board in capital markets and capital raising and companies being able to get public. SPACs have, this year, there have been about 100, as of a few hours ago at least, there have been about 167 SPAC mergers that have happened this year. That's in comparison, and when I talk about the SPAC merger, that's the D-SPAC after they've announced and they've closed and raised the capital. 167, there have been about just over 300 regular way IPOs. And there have also been 6 direct listings. So north of $500 million, 500 public capital markets events this year, which is astounding. If you look back over the last 10 years or so, we haven't seen that many in, I think since the late 90s, actually. SPACs have become very popular over the last few years for a variety of reasons, which we can talk about. But the amount of capital that's been raised through SPACs, the number of portfolio companies that are owned by many of you here in the audience have been able to get public through SPACs, where traditionally it would have been harder. The public markets are not the most equitable with respect to who can get public, and so SPACs have afforded just another alternative for companies to hit the capital markets and raise capital and continue to grow.
Good. So you talk about SPACs being another alternative to exits, and there's been some changes in regulatory developments in the last few years that have really enabled that. And I was wondering, maybe Shagufa, if you could share with us from the legal standpoint, what have been the key changes in the market that really enabled this market to grow in the last few years?
Yeah, I mean, in a way it's kind of funny because, we talk about this in the last 9 to 12 months, that it's kind of been the sea change in terms of how much more regulation in a way there is indirectly, and we were talking about it backstage. But I think it's not so much that there has been regulatory change necessarily, but at least from my experience, we've been seeing a lot more activity at a higher level in terms of size of capital raising. That has meant that the way to become public through a D-SPAC, there's many more opportunities, and so there's a lot more. It's not, I don't want to say it's regulatory, but there's just a lot more opportunity, and so as a result, we've seen, I think, heightened activity.
Right. In terms of from the SPAC sponsor standpoint, Jeff, what was it about the market that made you want to get involved as a SPAC sponsor?
Well, yeah, so that's an interesting question for me. So as I said when I was introducing myself, I'm also, lead a venture capital firm. And so what was happening to me was I was having sponsors show up at the office almost on a weekly basis wanting access to our portfolio companies. And what was really kind of outstanding, I think, in my mind, and again, I come from the public markets myself, I come from capital markets. And so what was bothering me about the whole thing was there was this massive lack of influence, this massive lack of knowledge with these individuals that were coming, right? It was really a transaction. And for me, and again, it's an artistic, difference, but for me, it was, I had a problem with that. So for me, it was like, we need to come into this space and we need to, for lack of a better way of saying it, try to clean it up a little bit. We have tremendous knowledge of the companies that we are looking at. We've been in the public markets, we've been in the private markets, so we have experience on both sides. So I feel like we can bridge it much better. And, so from a SPAC sponsorship, the reason why we got into it is we thought that there was a gap currently in the marketplace for the end investor, right? If you're putting the investor's interest at the forefront, that's kind of what we were thinking about and what we thought we could bring to the table, which was a differentiated, way of doing things.
It's also the ability to actually have to be able to acquire and help facilitate raising capital for a different profile of company, right? So it's a way to diversify the access to capital. So typically, if you're a seed fund or you're a Series A or Series B, you're doing smaller capital raises for smaller valuations. For many of the venture capital firms that have backed and sponsored SPACs, as well as private equity firms, they've looked at it as just a way to actually access larger companies, right? So if you raise $100 million in a SPAC, you're typically buying enterprise value that's 4 to 5, 6 times what you've raised in the SPAC. And so it's giving you access because many investment companies will have access to a lot of different opportunities of different sizes, but the one particular fund may preclude them from actually accessing those companies. And so a SPAC is just a way to diversify the access to capital.
Sure. On that note, though, I think the running joke last year was we all probably knew more people with SPACs than had COVID. So maybe you could share a little bit about the supply and demand side of the market and how you think that will kind of work itself out.
I mean, it was interesting. I laughed at a joke before. This was the last election. Somebody said if Donald Trump loses the election 4 years ago, then he's going to have a SPAC, which is pretty incredible because now he does. Look, the supply demand is, I think, and I've lived in the capital markets for 20 years. Supply demand is just like any other market, right? It's just like the traditional IPO market. There are the markets ebb and flow, and so when the title of this panel, I think, is have SPACs peaked, which is interesting to me because I think if you were basing your base case knowledge off of Q1 of this year, where 300 plus SPACs went public, right? There were 300 SPACs that went public in the first quarter of this year. If you're basing your sort of knowledge off that, time in the market, I would say any market has peaked after something like that. And so there was a tremendous supply and demand imbalance where you had 300 SPAC IPOs, but you didn't have enough mergers and enough previous SPACs actually consummating transactions with companies. But then in June, we started to see, and we can talk about what the SEC did in the end of the first quarter, which slowed everything down, and the whole SPAC market slowed down. In June, we saw roughly 35 mergers close. We had seen about 30 close between January and June, right? And so in June, we saw 35 close, a like amount in July, August, September, and through the past month. And so we started to see that equilibrium balance out a little bit. We're starting to see more IPOs coming out again. However, just this week alone, we've seen 5 SPAC mergers get announced. It's Thursday, I think. 5 SPAC mergers announced for $8 billion of enterprise value.
There was a big one today.
Grab closed today. for $30 billion of enterprise value, which raised a $4 billion pipe, and it had 0 redemptions. 2 other deals have closed this week, so 8 deals for close to $50 billion of enterprise value. Obviously, $30 billion for grab, but so have SPACs peaked? They're evolving, and the activity that we're seeing today, while not as robust as the first quarter, but again, I would not base our sort of the relative value to the first quarter. But if you look at the average over the last 3 years, the market is healthy and robust right now.
Sure. Shagufa, maybe if you could share with us a little bit from a regulatory standpoint, what was it that caused the slowdown earlier this year, and how do you think the SEC is viewing their regulatory stance towards SPACs?
Yeah, I mean, so, and I think it was early April, the SEC came out and said the way every SPAC has been accounting for the warrants. So when a SPAC goes public, they issue a share and a portion of a warrant, and that's a unit, and that's what is sold to the public, and it's sold for $10 a unit. And the SEC came out and said, well, actually, the way every SPAC has been accounting for the warrant is completely wrong in their opinion. So every SPAC had to go back and restate their financials. It meant that they went from equity treatment to liability treatment. Does it matter to the SPAC investor? I don't think so. But it meant a ton of work for all the lawyers and the audit firms, because all of these things had to be restated, which meant just generally I think, and Chris or others can speak to this, but it just felt like the market was very unsettled, because it was like, is this the first step in a series of steps of regulation, and is that just going to chill the market? So I think everyone was focused on getting their restatements done, because without those SPACs couldn't find a business combination candidate that they could merge with, because if their financial statements weren't valid, they can't then go and file with the SEC and get going on the de-SPAC process. So I think that sort of stopped deal announcements to some extent, because everyone was scrambling to figure out how to deal with it. Audit firms were super stretched. The SEC was still kind of like figuring it out. So when they kind of came out with their rule, I don't know if they realized the impact it would have. I think they were maybe thinking that it would slow down the IPO piece of the market. I'm not going to say they didn't think through it, but I think the knock-on effects were much wider than they realized. And so, it's not that there's more regulation per se, but there's more comments. Like, when you go through the SEC review process, either to become public as a SPAC or to get approval to go forward with a shareholder vote in connection with the de-SPAC, there's a lot more, I feel like, legislating through comments, where before you could get through the comment process in maybe, 2 months. Now you're seeing on average it's probably 4 to 5 months. It's because the staff is, while there may not have been a change in regulation, the tone from the top within the SEC, is that we want more disclosure. We think there was maybe inadequate disclosure before, and so we're going to ask a lot more questions. We're going to make you revise your document more to give the public more, what they view as more information before they decide whether to vote in favor or against the business combination. But really, everyone votes in favor for the most part. It's whether you redeem or don't redeem your shares.
Sure.
Maybe just one other point on that too. I mean, the sort of far-reaching implications that had on investors, I think, is important. There were 86 pipes that were announced in connection with SPAC mergers in the first quarter for something like $35 billion, and there was, I think, another 50 in the second quarter for $30 billion. So $60 billion of capital that was sitting in the pipe market that had been subscribed to was frozen. And so you had investors panic a little bit, right? Because if you're a traditional hedge fund investor or investment company, you're not accustomed to holding private paper for a long period of time. And when the SEC put a stop to everything, the average hold period for these investors went to like 6 months, which is scary. because if you're holding something for 6 months, obviously market valuation fluctuations can impact your willingness to continue to invest in pipes, and which is effectively the IPO piece of the SPAC. That's coming back now, right? We saw 4 of the 5 deals that announced this week had pipes. You know, there's been more pipe capital raised this year than we've seen over the last 5 years combined. So the market's still healthy, but that was one of the.
Is that a function of these mega multi-billion-dollar deals, or are you seeing that pretty broad in terms of pipe participation coming back?
So everybody talks about how challenging the pipe market is, and you maybe talk about this, but we're raising a number of pipes right now. It is challenging if you're focused only on what we believed were the sort of go-to traditional investors. So if you think about the Fidelities and the Wellingtons and the sort of brand name institutional investors, it is harder today to raise capital from those funds because, frankly, we're coming into the end of the year. They've been investing in 175 pipes this year and 300 IPOs. So just the level of activity that all of those funds have had to absorb has been record-setting. We're seeing the pipe market evolve, though, and this is what I think is so interesting about the SPAC asset class. Again, there are really four ways to get public. One is through a direct listing, but that's limited, right? There have been 6 or so this year. There's the traditional IPO, there's SPACs, and then there's just a reverse, which is just into a shell company, putting aside the SPAC piece. And so the number of ways in which companies can get public now continue to increase. And again, we haven't seen this type of activity since the kind of, frankly, the late 90s. The pipe market's evolving just like the SPAC asset class is evolving. The pipe market is now affording strategic investors, venture capital investors, individual investors, right, accredited investors to be able to come in and actually participate in the public markets. We haven't seen that in the past. So I think when you sort of peel things back, it's actually evolved to allow for more investors to participate in the market that wouldn't traditionally be participating in the public markets.
Yeah, I'm gonna piggyback on that. So 2 things. So you made the comment earlier about the ripple effects that the SEC might not have known of, and you were also saying that the pipe market really dried up afterward. And I believe that one of the biggest reasons why the pipe market dried up like it did is because there was this uncertainty. Is the SEC going to do more? And again, the timing, the hold time, was much longer than these institutional investors really wanted to hold on to. And so instead of taking that risk, they decided to just stay out of the game for a little bit. The second piece to that, again, from our firm's perspective, I think it's really getting super interesting because you have a lot of companies that are being built and created outside of the United States, in the Nordics, in the Latin America. I mean, and what that does from the pipe market, to your point, just taking it to another level, it's evolving. It's not the traditional, let's just go to, the most common pipe investors in the United States. Now you're seeing, family offices, you're seeing institutions from a venture capital perspective, you're seeing just individuals themselves in these emerging markets who want to get involved. And so if you're a SPAC sponsor and maybe you have identified a company, let's just say, we're here in Miami, it would be natural, for maybe a Miami company to be looking, for a target in Latin America. Well, that opens up the door to a lot of different ways of thinking with respect to how you might build out that pipe and who you might go and talk to about that, because they haven't had access to that in the past.
You bring up a good point in terms of the investor base of these companies, post-IPO or post-merger. One of the key differences between a SPAC path to a merger, to an IPO, versus a traditional through the front door type of IPO process is you don't have the long, drawn-out IPO roadshow marketing where the bankers are taking the company on the road and meeting 300 institutional investors and building a book of 200 or 300 names with all unfulfilled demand and underallocated, so you have good follow through in the aftermarket. How do you think that SPACs can kind of cover the ground there?
I'll take that. So again, I've been in the business for 28 years, and so I used to participate in those roadshows. It'll be interesting to see what you think of this, but like for our SPAC, my plan is actually to do the traditional roadshow. Once we have the ability to announce publicly our target, I know who my institutional investors are. My founder and the executive team of that company, myself and members of my team will go on the road. We'll be in New York for a week. We're going to do it the old-fashioned way, because the other element that I think we have to, as sponsors, be thoughtful of is your redemptions, right? So you've seen a lot of that. If your stock price is trading below $10, you're seeing a lot more redemptions. So what you really want to try to do is keep your stock price above $10, because then your institutional investors actually have to, they have to book a loss if they redeem. So that's really a big thing. But I think going back, as much as I personally like to look forward and really force myself and my team to be thinking outside the box, I think going back in time and doing traditional elements that have worked in the past is always kind of a smart thing to do. And so, yeah, you don't have to do it, but I think if you do it, it's going to have a significant positive impact. At least that's our opinion. We're going to test proof it and see what happens.
Chris, do you have any thoughts you can share on the differences there?
Yeah, there are 2 points in time, 2 primary points in time where you, as a SPAC sponsor and the company, will engage with investors. The first is when you're raising the pipe, and when you're raising the pipe, that's actually before the deal is announced, so the general public doesn't know that it's happening. But the company and the SPAC will go to institutional investors. Typically, when we run a pipe process, we're probably going to go out to between 50 and 75 investors. In the pipes that we raised in the first quarter, we probably had close to 50 to 75 that would subscribe to the pipe. And then you would announce the transaction once the pipe is subscribed to, and then there's a period of time over the next, it used to be 2.5 months, and now it's 4 months because of the SEC, where you've announced the deal. Now the world knows that this is a company that's going to go public. It trades as if it has gone public, right? Because you announce a transaction, and the SPAC trades as if the deal is going to close. You then go on the road, to Jeff's point, right? And actually, so we do a number of regular way IPOs, and we do a number of SPAC and de-SPACs. We were in the market on a regular way IPO this week. We priced a deal. We met with 120 investors, not all one-on-one, but we would have group calls, things like that for the management team. This is of the regular way IPO. About 80 came into the book. So you had 80 investors who actually subscribed to the IPO. It was an oversubscribed book. Yep. We have a de-SPAC that is going to close tomorrow. We have touched and engaged with 178 investors through one-on-ones and group calls and things like that.
How's the conversion of those 170 into actual orders?
We'll see tomorrow. But it actually, for this particular company, it's been strong. It's trading at $13.
So just to kind of talk about some numbers, I think looked at your weekly update that you sent. The year-to-date aftermarket performance of the average SPAC or de-SPAC is down 13%. And redemptions are at 67%, right? So yeah. What can you share with us, and Shagufa as well, if you can share any observations about what you think are the qualities and features that it takes to be a successful SPAC versus something that doesn't trade as well?
I mean, I think you need a really strong management team at the target ultimately, because they are going to be the business going forward. It's not all that different than if you were taking a company public. I don't think. I also, this isn't really a legal point, but I think it's, having forecasts that are believable and really defensible, because that's what you go out to the market with ultimately, and it's in your S4, and that's what people are focused on. And so, not legal, but I think that makes a huge difference to not have like pie in the sky numbers, which I think maybe a year or 18 months ago there was a little bit of that did cause some, and I think this is also part of like the regulatory scrutiny, it resulted in a lot of comments that SPACs are getting now through the S4 review process, that the SEC really pressure tests those projections, which, you know, a year and a half ago, I never got comments like that. And now, you know, routinely we're getting that comment to explain how did the company come up with that forecast? Why did they look at these peer firms, and why not these? And, you know, kind of, you know, they're doing their own kind of independent review of those forecasts, which I had not seen before.
Yeah, which is a new phenomenon, right? Because then, and this is the big difference between a SPAC and a regular way IPO. If you're merging with a SPAC, it's a merger. It's not a underwritten IPO, and so you're allowed, the companies are allowed to actually market off of and put in the presentation when they're doing the PIPE and the D-SPAC forward-looking projections, and so a bit of a new phenomenon for the SEC, but also that's part of the reason why of the 167 or so companies that emerged with SPACs, I don't know the exact number, but it's probably north of 100 are earlier stage, growth-oriented companies, maybe some, and many are pre-revenue, certainly pre-profitability. There are a bunch of panels today talking about ESG and sustainability. We've raised $5 billion this year for pre-revenue electric vehicle, battery, you know, charging infrastructure businesses that have now accessed capital and can grow their businesses faster. And the reality is, and we've also heard a lot today about, you know, how technology is everybody wants to move faster. Well, you need capital to do that. And so to your point, though, I think the SEC's done a good job of saying, oh, hold on now, let's slow down. How can you possibly forecast what your revenue is going to be in 2025 with a straight face? And so I think the investors are now saying, we agree with that. Let's sort of rein in what was, I'd say, irrational exuberance in the first quarter with respect to valuations. Let's bring it back in and say, okay, 2022, what are your numbers going to be? And how can we actually look at 12 months out?
So the SEC is actually commenting on forecasts?
Yeah.
Well, for sure, yeah. And one of the things, frankly, Gensler said, which I thought was really interesting, and we've been talking about this for a while, at least at Cowen, two things we've been doing. One, we've treated raising pipes and doing SPAC deals the same exact way we've done underwritten traditional IPOs from a diligence perspective, because we knew that we needed to be in that position. But the second thing was, Gensler said something along the lines of, well, you know, maybe we shouldn't focus so much on what SPACs are doing wrong, but instead, maybe we should focus on what's wrong with the IPO. And think about how we can evolve the IPO process to maybe look a little bit more like SPACs, because, wow, everybody's going public through SPACs.
I think we're out of time there. So thank you, the panelists, for sharing your thoughts with us. We appreciate it.